If you've been holding Tootsie Roll stock this year, you'd be outperforming the S&P 500. Not Microsoft, not Amazon, Adobe, but Tootsie Roll stock. You'd be up 9.89% year to date, and it's trading at a higher PE than Nvidia, Netflix, all the top companies in the world. Tootsie Roll stock is trading at a higher PE. And that's just the kind of market that we're in. So I thought that was interesting when I saw that the other day. But welcome back to another video. There's a couple things I want to talk about. I want to talk about the memory space a little bit, really SK Hynix offering their ADRs and kind of like what to expect with ADRs and kind of just explain like how ADRs work. And then I want to talk about 3 stocks that I have on the watch list that I am potentially looking to add to my portfolio. One being a stock that I used to have in my portfolio. I think it was a couple years, might have been last year or a couple years ago, I forget, but it's getting back down to levels that are very interesting. So I'll talk about those 3 and my thoughts on those. Before we get into it though, if you could just give this video a thumbs up, really appreciate it. It helps push the video out. And also on that note, just touching up on these last 4 videos that I posted. This one didn't do too well, but the 3 other ones, they've been doing really well with the views. I know it's not really a lot in the grand scheme of things, but for me, I'm not really active on YouTube too much. I don't post as much as I should be or want to. But you know, getting 800 over 1,000, that was my first video over 1,000 views. Definitely means a lot. So I appreciate everybody for watching these videos, liking it, helping push it out to other people. So definitely pretty cool to see that. Look, where we're at in the market, you know, I've been saying this all year. Everybody says that there's a crash coming. We're going to drop 20%, 15%, enter another, you know, get into this bear market crash, kind of like we did with the tariff dip back in 25. And the crash has already happened for a lot of stocks. There are an insane amount of deals out in the market right now. You know, I can go down the list. McDonald's. You can McDonald's is arguably like it is one of the safest stocks out there, one of the best stocks out there to own and have in a portfolio. And that's down for the year, right? Total from all-time highs, it's down 21% from all-time highs. Visa was one that was down and it's finally starting to recover, but that's another great company, right? I mean, we can go down the list and look at a lot of companies, whether it's growth companies, value companies, dividend stocks. It doesn't really matter. There's a bunch of deals out there, right? Obviously, Adobe stock has gone down pretty hard, but still, it's still a good company, right? That's another one. Netflix stock. TSM starting to come back down. A lot of these semiconductor stocks are not as high as they once were, right? So you can look at those companies. You know, there's Coinbase, you know, it's arguable, right? I'm not saying it's a safe company. What else? DraftKings, you know, yeah, I'm not really a fan of DraftKings. Not huge on Disney, but Uber stock, right? Uber stock is down. You know, 30% from all-time highs. Airbnb, still, I feel like Airbnb hasn't really done much, but regardless, you get the point. There's a lot of things that are on sale right now in the market, and a lot of people just think like there's another crash coming. Overall indices, right? Like the actual SPY index or S&P 500 index is not really down much, right? And I already explained like why. There's a lot of companies, small amount of companies that are carrying this index, right? It was a lot of the semiconductor memory stocks that were holding and bringing this index higher, right? And if you didn't get into those small amount of stocks like AMD, Micron, SanDisk, then your portfolio's not really doing too well relative to to everything else out there in the market, right? So that's kind of the reason for this, and that's why I think we're going to start seeing a rotation. And you're kind of like, I mean, we can look at Nike stock. I know Nike stock hasn't really um, done anything lately, but okay, for example, Netflix or Nike stock is green on the month, right? And then you look at a Micron, which is significantly down when you look at this, right? When you're looking at the Round Hill Memory ETF for the month, you're down 31% on the month, which is insane. Look at the SOX, the semiconductor ETF. For the month, you're down 18%. When you're looking at 30%, that's a crash, right? So when you're looking at the memory space, like it is a crash. Like 30% is no joke, right? And that's what's happening. So SK Hynix just recently offered their ADRs on the market, and I made a post about this. If you're interested in following me on X, I'm not too active on X like I am on Instagram, but I do post some good things there. So if you were interested in following me, definitely go for it. But this is what happens when ADRs are offered. When ADRs are offered, and this happened back in with TSM back in the day, ADRs are much higher. Now, not all the time, but when they first get offered, like for a company like SK Hynix they were oversubscribed, meaning that there was a lot of demand for their shares, right? Because the memory industry has been booming. Everybody wants to get a piece of it, right? And SK Hynix is the leader in the memory space. So what is happening is that their ADRs, right? They're traded in. I can go on Robinhood, buy the ADRs in US dollars, and a direct that's not direct access to the actual listing in Korea, the Korean exchange, right? So like I'm not buying the SK Hynix shares in, I don't even know the currency in Korea, but they're much cheaper when you're buying it in their currency. And you can see here why the ADRs they're trading at a 15 to 25% premium to the OG listing, right? And that's what I mean by that in this post, right? So that's what's happening right now, is that all these American investors want access to SK Hynix, right? And it's boosting the ADR price up, but it's not it's a lot higher than the OG listing in Korea, right? So the reason for that, right, is obviously because like me, or anybody watching this, you probably, you got to make a brokerage account in, whatever Korean brokerage. I don't even know how to do it, to be honest, but that's my point. It's very difficult to do that and have access to the direct listings. You got to convert currencies. That can be pricey, right? It's ADRs just make it a lot easier for investors, right? And that's also why people do it, because it's just easier. They don't have to, convert, exchange in currencies and stuff like that. And it's just a lot easier, right? But this is what happens, is that when you have something like this that is pure momentum, you're paying a price, right? A high price for it. In the actual business itself, like that it's trading at a premium, but people are still like buying into it, right? And now what happens is a lot of people, there's regulations with these ADRs, right? And what a lot of people try to do, bigger institutions do this because they're just able to move faster. They're able to move money faster. You buy in the Korean exchange, right, which is cheaper, and then you try to convert it into ADRs. Now you can't really do that right now, but that is because of the regulations and stuff like that. Later down the line, if regulations start to get, I guess, ease, then it's going to be easier for some people to kind of get away with that. And that's a risk that a lot of people are trying to kind of talk about, is like people that are buying the OG listing and then eventually converting that to ADRs, and kind of it's called arbitrage. So you're kind of like trying to like get the difference in the dollar amount, between it. Again, can't really happen right now. That's why the price is where it's at right now. But it's just a risk that a lot of people try to look out for with stuff like this. But that's what kind of happened with TSM. They offered ADRs in 1997. They actually did really well at first, and it had crazy volatility though between those times, and eventually crashed 80%. Obviously, that was because of the dot-com bubble. But it's just interesting to kind of see, like, right there on the Taiwan stock exchange, and they started offering ADRs back then because they were like the hot commodity back in the day. and kind of interesting just to kind of see like what happened. But that's kind of like what happened is people were trying to arbitrage trade their way from the ADRs to the actual original listing. So just a heads up, that's what's kind of happening with the ADRs is that they're trading at a 15 to 25% premium to the actual listing in the Korean exchange. So just understand that that's what's kind of happening. You know you're paying more for what it's worth. Just know you're paying more than what the actual SK Hynix business is worth when you're buying the ADRs right now, which is why I stay away from it. Anything with like IPOs like SpaceX, right? Big IPOs like that, it's not worth buying. Just let the dust kind of settle and then kind of just like evaluate when prices start to come down and actually start to make sense. But the memory boom right now, I think a lot of people are understanding, okay, yes, they're growing their earnings per share at like a really, really good rate, but there's going to be a time when those PEs start to go up and the earnings start to top, right? And that's what the market and all these big institutions are trying to kind of front run is we know a year ago or 6 months ago that they were going to just blow out earnings every single quarter. But there's going to be a time where it tops and then it starts to go down, it starts to contract, and then the stock price is going to get killed. And the institutions, all the big money is trying to front run that and kind of time it in a way. And that's just what's going to happen, right? Supply is going to outweigh demand. And the memory companies can no longer price hike. You can only do that so much, right? Before these companies are just like, this is ridiculous. I can't keep raising prices on my customers, right? We have to do something about this. So that's what is happening. Just kind of like small overview in the memory space. I don't want to go too deep in it. That's not the point of this video, but the ADRs that SK Hynix is offering, just know that you are going to be paying a premium to the original listing and what the company is actually worth. Moving on. So the first company that I have on my list is Visa. Now, this one has kind of already ran pretty crazy. Not crazy, but to where it was. I wanted Visa under 300 and I thought it would have stayed there a little bit longer. I was too busy buying up Microsoft, SoFi throughout this year and you can already see like this. The thing with Visa is this stock, the like MasterCard, American Express, these companies recover so quickly. Like it's like they like almost never go down. It's crazy, right? There's not really much explaining to do about Visa. Everybody knows the business that they're in. But you're looking at a company, right? Like you look at their profit margins, like these are some of the best profit margins in the entire stock market. You're talking 50+%. Like literally they haven't dropped below 50 since 2020, right? Like it's crazy to look at like a company that's running such high profit margins. It's like why wouldn't you want this in your portfolio? It's one of those companies that I feel like it's just good to have because it's just a slow, steady compounder. And when you can get a deal with it, like under 300, even like the low 300s, this is exactly why, because the stock just recovers. And I mean, these stocks, these companies have the best business models in the entire world, pretty much. They make a boatload of money. So I just think it's interesting to kind of see, um, you know, I'd never had anything like this in my portfolio, but I think it would be worth adding to the portfolio. Even now, I feel like even now at 358 is like just like why? If I don't plan on selling it for 5, 10 years, 15, 20 years, then it doesn't even matter what you're paying for with a company like this. That's the thing, right? You just add to it steady and slowly. They pay a dividend, right? I don't know what the yield is right now. It's a lower yield, right? Because they kind of focus on growth. But it's just one of those companies I'm looking to add to. If it ever does come back down, I'll probably look to add and not miss that chance. But yeah, I mean, Visa is a great company. Not really much to say about them as a business. Netflix is the second stock that I am potentially adding into the portfolio. I've never owned Visa and I've never owned Netflix. And Netflix is finally coming down to a level that is very intriguing, under $70. So it's down 26% year to date. And I made a video about this. I'm not going to actually show it, but I posted it on X. So I posted this actual video on Instagram back in February. Back in February. And I talked about this like formula that Wall Streeters use to kind of, it's called a break even revenue. And it, in this video explains it. You can go and watch it, but basically at the price that it was trading at in like the mid 70s, I think it might have been high 70s, their revenue, their expected revenue by like 2030 was like 93 billion. That was like the expectation of Netflix's revenue, right? So they would nearly have to double their revenue in like 4 years, which is insane for a company like Netflix, right? If it was a company like Nvidia, AMD, like companies that are very high growth right now, that would make sense, right? And I'm not saying it's impossible, but it'd be very, very hard. And basically, Netflix was getting priced even at $78. Netflix is being priced like their ad business is like being priced to be executed at absolute perfection over the next 4 years. And I don't think I don't think they're going to get to 90 to 93 billion dollars by 2030. And that's not me being a bear. You have to just be realistic as an investor. At the end of the day, Netflix is like a top company, like blue chip, as good as it gets. They've been a phenomenal stock to own over the last 2 decades, right? But, and that's okay if the stock's coming down. But at the end of the day, it all depends on what you're paying for a stock, right? And then there's a margin of safety that comes into play, right? So, like when a margin of safety happens, you look at a company like PayPal. The margin of safety really starts to come in when you're getting this stock under $45. I think this actually went under $40 at one point. The stock is more likely to go up than it is to go down, right? When you look at a company like Netflix, there's still a lot of room left for the downside that it could potentially go down. Doesn't mean it will, but my point is that it always matters what you're paying for a stock, right? And can this go down to $40? Sure. I mean, we've seen that with stocks that I would have never thought would have went to the levels that they went for. Nike, for example, $43. I never thought I would have saw a four in front of Nike when I was buying it in the 70s, right? And here we are at the fours, and it's pretty much been dead money for a pretty long time, right? But Netflix, just going into what's wrong with Netflix right now is that they're slowing down their growth. That's what's happening with them, right? So last quarter, they showed a decline in growth and revenue. This quarter, they had 13%, and next quarter, they're guiding for 11%. So you can kind of see like what's going on. It's going down. That's what's happening, and that's what investors are worried about and concerned about. And the thing with Netflix is that the industry that they're in, the streaming business, has changed a lot over the last 8 to 10 years, right? Even the past 5 years, right? You have a lot of players coming in, Amazon, even companies like Fubo. You have free streaming services that are coming out and taking viewership. Obviously, you have the social media platforms, YouTube. You have a bunch of different platforms that have really come into the game and have taken away a lot of viewership and a lot of content away from Netflix. And that's the issue, is that it's becoming very saturated. And that's why they were potentially looking to do M&A to kind of help condense the streaming industry, right? And get more viewers to come onto their platform. So it's interesting. I'm not looking to buy it right now. Well, I am, but I don't think 69 is where I want it. I want to just let the dust settle. I want to wait over the next month and kind of see where the stock kind of starts to trade, because the day after earnings is when you get that initial price move, but that doesn't really say much, right? I want to wait and see after the earnings are digested, everybody does their research, puts their, fixes up their models with the numbers, and then kind of just like see how the stock price trades. I'm not in a rush to get into this at all, but I am thinking what is happening with Netflix is that people are starting to kind of potentially re-rate this company as, a slower growth company where they're not willing to pay 30 times earnings anymore, right? They're going to pay a 19 or an 18 PE. It's getting to that like mature phase of the business where it's not going to be growing 20, 30, 40%. I think those days are done. So we'll see. I could be wrong, but again, play it patient. I'm not in a rush to get into it. I did have a Yeah, here it is. So we can just run the numbers really quick, just basic kind of um, projections here. Net margin, we'll just do 4 years, but here are the projections for Netflix really quick. So base case, so by 2030, the stock price would be $99. By next year, it'd be at like $72. And then this is the bull case over here. Now, look, when you're looking at, I mean, a CAGR of 9.5% really isn't attractive for anybody, to be honest, over a 4 year period. But the bull case, if it grew even 15 to 20%, it's not terrible, right? But it's not exciting for a lot of investors anymore, right? They want to have the higher, depending on what kind of investor you are, they want to have higher growth companies, right? It's not terrible, but that's what you're going to get with Netflix, right? You don't expect like the insane growth that it once gave you, 10 years ago. It's just not going to happen. At least that's what it seems like, unless they just find some new catalyst that excites investors. It's going to stay potentially dead money for a little bit. All right. Last company, Celsius. I don't want to spend too much time on Celsius because this video is already running a little long, but Celsius, I used to own Celsius back in, believe it was like 20, I don't even know what year it was. See if I have any like old tweets over here. Okay, so it was 25. So I started buying it in 24, and yeah, and then I started buying more in 25. Yeah, so I was like really in Celsius. I bought it at like $31 and then sold it when it went down to $22, and then I sold it when it went up to like $45. So I made some decent money on it. Um, but it's going right back down below $30, and that makes it attractive. The thing with Celsius and why it's an interesting company, right? When you look at a company like Celsius, the energy drink market, they own, first off, the Celsius brand is really strong. They have Alani Nu, which is another strong brand that's targeting more of the like female demographic. So they have a really strong product with that. Rockstar energy drink that they took off of Pepsi, and Pepsi distribution helping them. Like they're doing all the right things and they're growing very well in the energy drink market. When you look at Monster, Monster has been the best performing stock in the last like 20 years of the entire S&P, right, in energy drink market. Now, I'm not saying that's what's going to happen with Celsius, but the point is when you look at a mature company like Monster and you look at their profit margins at 23%, right, you can kind of see their profit margins are pretty steady, about 20 plus percent. Celsius right now is not in the same realm as a business as Monster. They're still growing, right? Look at their profit margins right now. These fluctuate because they've done some acquisitions, right? So their profit margins are going to look bad on paper. They're still growing the business. They're still reinvesting back into it heavily. But once this starts to materialize in the numbers and they really start to kind of like take back on investing a boatload of money into the business, these margins are going to start to expand and get into 15, 20%, right? And then when that happens, you're gonna start to see the valuation really start to ramp up and expand again and probably get back to $100. So that's kind of like the base case scenario with Celsius. Where it's going to be at this month or next month, I mean, I don't really know. It doesn't really matter, right? But over the next few years, when this company really starts to expand their margins, their valuation is going to really start to go up pretty significantly, right? So that's kind of like just the base case. I don't want to make this video too long. We're already at like 25 minutes. I tried making it less than 20, but yeah, I'm going to end it here. So I appreciate everybody for tuning in. Let me know what you think about these three stocks: Visa, Netflix, and Celsius. Three valid companies. One being that higher growth, right? And then Visa giving you more stability, and then Netflix being a nice value stock right now. But yeah, let me know in the comments what you think, and I'll see you in the next video.